All right, so welcome to the first lesson. We're going to in creating financial statements. Today we're going to look at the trading account. The purpose of the trading account is to get gross profit. So if you remember, how do we get gross profit? Selling price minus cost price. That's the logic that's being used here. But in this case, the selling price is going to become sales revenue, or is referred to as sales revenue, because this is the money that you make through selling your goods. And your cost price basically will be referred to as the cost of the goods that are sold. So I'm going to illustrate to you how we make a trading account. So we've got this information for company C here, right? We've got the sales revenue, money made from selling the goods, 90,000. We have the opening inventory. These are the goods that you start with at the beginning of the financial period, right? When your financial year starts, the goods that you have in stock, that is your opening inventory. Then when the year ends, the goods that you have in stock, that is your closing inventory, right? So when the year ends, the closing inventory is the goods that you have in stock. When you go into the next year, that closing inventory becomes opening inventory. Okay? Yes. Purchases, this is how much we paid to get new goods, get goods for resale. All right. Closing inventory, as I said, goods at the end of the year, the goods that you have in stock. Then when the year begins, they become your opening inventory. Sales returns, when customers bring back goods to you. When customers bring back goods to you, you have to give them back their money. So it's going to have to reduce your sales revenue. Carriage inwards, this is the delivery fee that you pay so that the goods are brought to your premises. If your supplier delivers goods to you, obviously there's going to be a transportation fee or a delivery charge. That is the carriage inwards. And yes. So this is how we begin, how we make our trading account. Okay, let me just put this. Yes. So the first item we're going to put is our sales. This is the money we made from selling our goods. So we record it here as, excuse me, 90,000. Oops, let me put this side here. All right. The next item we need to record is the sales returns, because we made 90,000 in terms of sales, but customers bought goods worth 500 kwacha. So we need to deduct that because we had to refund our customers. So less sales returns. Sometimes it's not always just about the reasons why customers will return goods. The goods can be damaged, bad. They can be the wrong goods. They can be expired. So there are a lot of reasons why customers will bring back goods. So sales returns here, 500 kwacha. Right. So when we deduct what we made from selling our goods minus what the customers brought back, we made 89,500 in sales revenue. This is what you call your net sales. In accounts, whenever you hear the word net, it means something has been deducted. So in this case, sales returns or return inwards, that's the other name it's called, has been deducted from the sales revenue. So remember that sales returns is also called return inwards. Okay, the next thing that we need to tabulate now, we've done the first part of this formula here. We've got our sales revenue. Next, we need to tabulate the cost of goods sold. So in order to determine your cost of goods sold, you need to find the total cost of goods available for sale. This is the total value of the goods that you had at the beginning of the year and the goods that you bought throughout the year. You want to total up their value. That's the total cost of goods available for sale. Once you get your total cost of goods available for sale, you need to deduct the closing inventory. Remember, you cannot make profit out of goods that you haven't sold. And according to the matching concept in accounts, revenues earned should match expenses incurred. So we're only interested in the cost of the goods sold. Okay. Yes. So first things first, when determining your cost of goods sold, you need to record your opening inventory. Opening inventory 1000. After you have your opening inventory, you need to record your purchases, the goods that you bought throughout the year. Okay. How much they costed. These are the goods for resale. Okay. So in this case, we bought goods worth 750 kwacha. Then to bring those goods to our premises, it costed 7,500. All right. So this is not just for a one-off payment. You obviously throughout the year, the total amounted to 7,500. So carriage in once 7,500. Okay. So we total up purchases plus carriage in once 8,250. This is the cost to buy our goods and bring them in. Okay. So, next thing, we need to know the total cost of goods available for sale. And this is where we add our opening inventory and the purchases. And you get 9,250. That's the total cost of goods available for sale. TCGA, yes, total cost of goods available for sale. So once you've got your total cost of goods available for sale, you just need to deduct your closing inventory so that you get the cost of goods sold. So the closing inventory is 600. So it's a less closing inventory 600. So the total cost of goods available for sale minus the closing inventory gives us the cost of goods sold, which is 8,650. So once we've got our what our sales revenue and the cost of the goods sold, we can now get our profit. So profit is sales revenue minus cost of goods sold, 80,850. That is the gross profit.